Today on InvestTalk, we discuss if the major market rotation out of tech and into small caps in the past week will hold. We then discuss today's market moves and answer caller questions about General Mills, Occidental Petroleum, ServiceNow, and more. And at the end, I look on a report about the remodeling activity in the housing market in 2025.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today is about the market rotation. Huge market rotation that was really kicked off by a couple factors. The main one was the inflation figure that came in last Thursday, and it came in flat year over year. Fell 0.1% month over month. Year over year slowed to 3%. This is the CPI figure. And it really gave market participants and likely the Fed a little more confidence that inflation will continue to head back towards the target of 2%. Now, what's interesting here, and definitely of note, is that, hey, we're not at 2%. 3%, that's 50% away from that target. Yet the Fed is still already talking about a potential rate cut in the month of September, which you already have about a 90% priced into futures markets that we will get a rate cut in September. So that's number one. And ultimately, it started the weakness in the dollar, and you kicked off a really big move last Thursday, the biggest we've seen really since 1986. Okay, what happened on that day was that the Russell 2000 was up 3.6%, while the Nasdaq was down 2%. This is the biggest one-day outperformance for the Russell over the Nasdaq going back to 1986. That's on record going back to 1986. So it was a record, okay? So what you're seeing is hedge funds. They call them hedge fund hotels. There's a lot of stocks that are trending, and there's a lot of institutional ownership from hedge funds. And they ride that wave, but they're quick to get off. And that's what you're seeing right now, is that this is a shift in positioning in a big, big way. And the equal weight S&P 500 also outperformed on the day by about 1.8%. So you're talking about the same names, just different weightings, right? The traditional S&P, that's market cap weighted. The equal weight, every one of the 500 names is weighted the same. They call it equal weight. And so to have the exact same basket of names, just with different weightings, to outperform by 1.8%, that is a massive difference. And the S&P is being dragged down by tech now because it's so overweight, and now money is flowing out. And ultimately, this doesn't mean that the market has to crash or anything like that. In fact, the fact that there's really no fallout in the credit market says it's not likely to be a major drop in markets. 8, 10, 12%. Sure, certainly possible in the third quarter. But this September rate cut will continue a wave of cuts by major central banks, which means larger amounts of liquidity injections. But instead of everyone else loosening and us staying relatively tight, we're going to join the party, which means the dollar is likely to head lower. And that is a boon for domestic producers. And most of the small cap names are domestic producers. Those large cap names, mega cap names tend to be more international, and they're okay with the dollar strength, because that means their other currencies are getting weaker. And so when it translates back into dollars, it's better for them. So basically, this weak dollar situation is good for the small caps, and that's why they are surging. All right, we're heading into a break, so give me a call now at 888-99-CHART. Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Now let's take a look at the market today. We continue to have some follow through from the sell-off in the growth side of the market. Large cap growth down 1.25% today. Large cap value did also sell off as well, though, down 1.1%. So outperformed, but more in line. And that was kind of the interesting trend over the past 5 days before today, was that there wasn't a lot of correlation in markets. You know, you had the growth side really selling off in a big way, and many parts of the value side being green, right? And that's not typical. Even if one part of the market outperforms another, they typically move in the same general direction, kind of like today, right? And the story of today is that the small cap side of the market did have a nice little setback here. The small caps are down about 1.4% after that big surge. And I said, I believe it was the day before, yesterday, it was yesterday, that was definitely a bearish topping tail on the Russell 2000 on yesterday. And you had follow through to that downside today. And a lot of that to do with the strong dollar. We talked about how a weak dollar is good for the small caps, and you had a bit of a strong dollar today. So that was the market today. I think there's still a lot of jockeying for position. Could it be behind the scenes that, like I said, I think there's increasing expectation that Biden will be dropping out over the weekend. The betting markets are up to nearly 90% on him dropping out. Let's see, what's Polymarket right now? Polymarket is usually where I go to see how money is actually flowing into different bets in the political realm. And yeah, Biden's chance of dropping out of the presidential race there is at 91%. Okay, so the rumor is he will drop out of the race. He will stay as president until the end of his term, and he will not endorse Kamala or anybody else, and he will endorse a kind of an open election. An open primary. So that'll be interesting. And that could put this Trump trade on pause. The market figures out, okay, what does this really mean? Are they going to is there going to be a candidate that will make this race a lot closer, because the recent polls are not close? And so that will be a very interesting story tomorrow and into next week. In the midst of earnings season, right? There you had ASML with the big earnings yesterday that had the big sell-off, and that had follow through again today. And so intermixed with all of this political news, you still have earnings numbers that the market is certainly paying attention to. And when they don't meet expectations, they're likely to be hit big, especially because a lot of the hedge funds own these big tech names, and if those expectations aren't met, it's going to sell off in a big way. So be very interested to see how this evolves as we go through earnings season and this election season. So continue to expect volatility in both directions, but I do think a new trend in markets is likely here to stay, which is value over growth.
Hi, I was looking at your take on UL Solutions, ticker tape ULS. Stock I've owned for the last few months now, and I'm up a little bit. It's had a good run, so I'm just wondering if now's a good time to sell it and move on, or if I should continue holding. Love to hear your thoughts. Thanks for going.
All right, this is a recent IPO. ULS is the symbol. This is UL Solutions, and it is a mid-cap name, about $8.8 billion market cap. It's a global leader specializing in a broad range of product testing, inspection, and certification services for, let's see, it's, I'm just trying to see. I've never heard of this company because it's so new. Yeah, industrial, two segments, industrial and consumer. And as a software business, et cetera. So it's doing well. If you look at its earnings, they are expected to be up about 10% this year, but up 6% next year. The issue, though, is that it's trading at a pretty hefty multiple. And this is very common after an IPO. You get a lockup period of 6 months. Well, it went IPO in April. So the lockup period will last probably through September into early October. And when that happens, when there's a lockup period, the insiders who sold some of the shares, they can't sell anymore. Okay. And they, after 6 months, then they tend to kind of realize that those gains and those higher prices, which you've seen, as IPO'd in the mid 30s, now we're in the mid 40s. So obviously a nice gain over the first few months. And the reason it typically rallies is because there's a low amount of shares that are out there to be traded on a regular basis. For example, right now, the total shares outstanding are 200 million. Okay, 200 million. But the shares in the float are only 38.5 million. Less than 20% of the total shares outstanding are out there to be traded. So that's one of the issues here. It was down pretty nicely today as well as yesterday. I think this is a clear name to at least trim at these levels because that low float is really what's driving the valuations higher currently. Because it's pretty expensive. You look at a enterprise value to EBITDA is about 17 times, which, if it was growing really fast, that'd be fine. But it's not really, right? Last quarter, revenues only grew 7%. The next 2 quarters, revenues are supposed to be flat year over year. So it's just still a relatively low growth name. It's trading at a premium valuation. So I would be trimming ULS at these levels before that lockup period ends in a few months. Thanks for the call. Now we have a lot of ground to cover over the next 45 minutes or so, and time permitting, we will tackle all of it. Remodeling activity. There's a new report on expected remodeling activity of homes in the second half, in 2025, and we'll look at those estimates. And then lastly, if we have time, should couples consider staggering their retirements? We'll look at that story as well. So that's what's on the docket for us today, as well as your voice bank questions. We have one on tips for travel investors, as well as ACGL Arch Capital Group. And we have questions submitted via our YouTube channel as well. And of course, most importantly, it's your live calls. We love your voice bank questions, but we especially love those live calls. We get to kind of interact with you live. So don't hesitate to reach out. 888-99-CHART is how you get through and ask your question on today's show. Now we're heading into a short break, and on the other side, I'll take your questions on the InvestTalk Anytime listener line at 888-99-CHART. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors. Now let's pivot back to the InvestTalk Voice Bank for a question that came in earlier from Israel.
Hello, InvestTalk. This is Matt calling from Tel Aviv. My question today is about Anglo American Platinum. The ticker, I think, is AGPPF. I'm looking for a pure play, as much as possible on platinum and palladium. For what I can see on Morningstar, they have a good profitability, low debt, but I do see some concerns on the growth moving forward. Not sure if I'm reading it right. And my question is this a good time to get in? Is this even the best company in the space? Or should I keep looking? Thank you very much, as usual. Love the show and keep up the good work.
Appreciate that. And looking at Anglo American Platinum, AGPPF, this is the world's largest primary producer of platinum group metals. Platinum, palladium, rhodium, iridium, and many more. They even produce some base metals, copper, nickel, cobalt, sulfate, sodium, sulfate, etc. And, if you're talking about a pure play, that's not very pure play, right? So my issue is it's not a pure play, and the fact that the chart just continues to head lower. It's trading well below all the major moving averages, and lower highs, lower lows. I'm not seeing a whole lot of indication that this downtrend is going to spin out and go the other way. Now, they do have a good balance sheet. The free cash flow is negative, though, despite different parts of the commodity markets with some strength. Now, yes, platinum and palladium are down, have been down in the dumps, and they're gaining some momentum because, as I said, I believe it was on the Tuesday show, that the demand for platinum and palladium will likely increase or at least stay steady as more and more companies are moving away from purely EVs and focusing a lot on hybrids. And so that still require catalytic converters, et cetera. So if you're looking at a pure play, and that's really the issue with the platinum space, is how do you get a pure play? Well, there are ETFs, PPLT is one example. It's physical platinum ETF. That would probably be the best pure play on higher platinum prices, if that's what you were looking for. Historically, Anglo American, it's not a terribly run company, but it's certainly not the best in the industry. And so I would just buy a platinum ETF over this one. Okay. Thanks for the call. Let's go talk to, was it Sammy from San Francisco. How you doing, Sammy?
Yeah, doing well. How are you doing, Justin?
Good. Thanks for the call. What can I help you with?
Wanted to ask you about a stock ticker Now, N-O-W, ServiceNow.
Mm-hmm. This is one of the most successful cloud software companies that's been out there. They tout very high retention rates, and it's always traded at a bit of a premium. And I say a big premium to markets. Price to sales ratio is 16 times. Enterprise value to EBITDA is at 80. That's pretty massive. Revenue growth continues to power higher in the mid-teens. But earnings growth is expected to slow pretty considerably this year and next year. Last year, earnings grew 42%. This year, expect to be only 25%, and next year, 20%. So, what multiple do you put on that type of business is a big question. And they develop cloud-based IT software for workflow automation, data consolidation, and business administration. So, very good company, but, what is a reasonable multiple to put on a name that as solid growth, but certainly slowing growth, and that's a tough question to answer. The technicals are certainly weakening. Momentum has been really neutral to negative since February as the market has powered to new highs. So that relative strength as of late is not looking so good. So I just think of these valuations and what's happening in broader tech. I would be patient on it. The there's MACD divergence as well on the weekly, which says that this recent move higher before this the sell-off the last 2 weeks, that it was kind of not something to be believed in. So I would be patient on it. I wouldn't touch this at least until 540. Now it's at 740-ish at the close today. So I think there's a lot more downside to come before this gets interesting. And the technicals, at least in the near term, are not looking that great. All right, we're heading into a break, so give me a call now at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
On the next Invest Talk, we'll look into this question: is a scarcity mindset holding you back financially? In times of economic uncertainty, it's easy to fall into a scarcity mindset where fear and worry about money can negatively impact your financial well-being. However, by shifting your mindset and adopting practical strategies, you can build financial resilience and weather any economic storm. We'll dig into that story tomorrow, but now let's grab another caller question from 888-99-CHART.
Hi, my name is Ernesto from Visalia, California, and I'm calling about a stock. ACGL is a ticker, and I'm calling to see if you have any revenue estimates and earnings per share estimates moving forward, see if you have any growth. I've owned it for about a year now. Just want to know if you see any growth in it. I think it's a good insurance company, and could you let me know your thoughts about it moving forward? Appreciate what all you do, and my thoughts and condolences go out to Steve and all the family there at InvestTalk. Thank you very much. Have a good one.
We appreciate that. And you're looking at Arch Capital Group. This is in the insurance space. It writes insurance, reinsurance in Bermuda, the United States, Canada, Europe, Australia, and the UK. $37 billion market cap. So a very quality name and well-diversified and very good profitability. You're talking about return on equity, 29%, return on invested capital, 25%. So yeah, quality name here that we definitely like. Now, what the earnings estimates are, they are slowing, shall we say. Last quarter, revenues are up 24%, earnings up 42%. But this upcoming quarter for Q2, up 14% for both revenue and earnings. But Q3, the quarter we're in right now, revenue is supposed to be up 18%, but earnings down 29%. And for total 2024, earnings are only supposed to be up 1% year over year. So that's a stark deceleration from the 74% growth in earnings that you saw last year. So that's why you see this is trading at low teens multiple. But I still think it's a good name. I probably wouldn't sell it and maybe even add to it on this recent pullback. So I like Arch Capital Group. It's very profitable. On our watch list to buy, frankly, but not a name that we own currently. So thumbs up to Arch Capital Group. Now let's touch a bit on the Trump trade, which is it has a lot of relation to our main focus point about that market rotation. Part of it was the move towards a more dovish monetary policy here in the United States from the Fed and a more calm inflationary environment. That's what kicked it off. But I think what poured salt on the wound was the attempted assassination of Trump over the weekend and the increasing likelihood that we will get a Trump administration. Now, what does that mean for markets? What are markets starting to price in? Because for a while the script was, hey, both of the candidates are going to spend a lot. They're not going to shift policy very much. Now, I think that was generally true until really the VP announcement. J.D. Vance is certainly an economic populist, very different from Mike Pence, who was a traditional Republican from the last administration. So Trump's economic policy platform is likely to become clearer, or has become clearer since the J.D. Vance decision. And the biggest takeaway from Trump 2.0 is that his policies will be more inflationary, increasing in trade tariffs, tax cuts for businesses and wealthy individuals, deregulation, and crackdown on immigration. All of this is a recipe for higher inflation, and the market is pricing that in. Okay? And you saw that with the big market move on Monday, the first trading day after the assassination. Long-term bonds sold off. Okay? And once J.D. Vance was picked, what was that, Tuesday? That was another kind of shot across the bow that, hey, this is on. This inflationary regime is likely to reaccelerate probably sometime next year. Why? Because JD has some serious stances on controversial issues. Economically, I'm not going to talk about the social side of it, but because that frankly doesn't matter much to the markets. It's about the economic policy. Number one, he's against the war in Ukraine and us funding it. So what impact that will have on defense contractors, for example. And he certainly is hawkish on China. So China's already having problems with major debt, a collapsing housing market, et cetera. And I don't think it's going to get any better under another Trump administration. But what's most important, on top of the fact that we have a Fed that's likely to cut rates, is that Vance is fond of the weak dollar, that the dollar reserve currency is actually in many ways negative for the country, especially the industrial base. And so he is for a weak currency, which is also inflationary, right? So there's a couple things that are pretty clear. A Trump presidency is still not certain. We know that. But it would be a very different, not to say very different, somewhat different economic prescription for the country. And the other is that if he is elected, there is likely going to be a push towards making the Fed maybe less independent. Right? He's not afraid to throw his weight around, figuratively, and really push the Fed to do his bidding in many ways. And so if he wants a weaker dollar, and he's likely to push the Fed to lower rates. And he's a real estate guy. So lower rates are things that he likes. And obviously that will help his personal net worth. And so the big question is, what kind of impact will that have on markets? Institutional credibility is hard to quantify. And so if that independentness of the Fed is suddenly called into question, how does that impact the price of our bonds? And I think that will be probably the biggest risk to markets in a second Trump presidency, is that if the confidence globally in our institutions and the ability to manage the economy effectively is called into question, especially on the fiscal side, that will reverberate in markets, and that's something we will be watching. Now, I hope you've been telling your friends about the InvestTalk audio podcast over on our YouTube channel. And we get questions submitted via the comment section. And here is one that came in yesterday, actually came in today earlier. And it is from Jim Leahy. He says, thank you for a great feedback all the time. What are your thoughts on AIT? AIT. This is an ETF. It's not an ETF. Just pulling it up here. It's not an ETF. It's an industrial company, machinery and tool subsector, and distributes industrial products such as power transmission, components, tools, bearings, products, etc. And I love this type of business. Okay. The issue is that, revenue growth, earnings growth is expected to be not that great, not that amazing. The 1% last quarter revenue growth, 2% earnings growth, and this quarter only 2% revenue growth, 9% earnings growth. So, it's still a slow growth name, despite the fact that I like the industry that it is in. The technicals are certainly fine. That certainly had a nice little boost here recently on the small cap breakouts. It's more of a mid cap. It's about $7.5 billion market cap, but certainly domestically focused. And I like the business overall. Return on equity 30%, return on invested capital 12%. They have pretty minimal debt compared to the size of the business, revenues and cash flow, et cetera. My issue is that I think it's too expensive. So I like the space that you're looking at. I think it's a good company. I just don't like it at these prices with the lack of real growth there. And I would be looking for other names within this space that are giving you better value with similar profitability, because there are some, we actually own them for clients. So that's how I know that. All right. Thanks for the question. Now, 2024 is moving fast, and the proof is that we are in the third quarter. First half is over, and we just kicked off a new market shift. So we're talking about on today's show is that rotation in markets. And the big question is your portfolio ready for that? Are you sitting like a lot of the hedge funds, overweight, big mega cap tech, and now you probably are taking on the chin? Well, when you get this level of breadth thrust, for in small caps to the upside, in those mega cap growth names to the downside, that is usually the start of a longer term move. This happened in beginning of 2022. You saw that with that huge sell-off in the NASDAQ, down 33% over the coming, over the calendar year of 2022. Not to say it's going to happen exactly the same, but it's likely to echo that in some way. And so the question is, your portfolio set up for this market rotation? And if you need help understanding whether it is or it isn't, whether it's aligned with your goals, building out a full financial plan, etc., I encourage you to reach out to me at KPP Financial, where we practice parallel investing, which means we invest right alongside our clients, and we operate with the same philosophy, which is independent thinking and shared success. So I encourage you to take advantage of our free portfolio review assessment via telephone or Zoom. So set up a message or send us a message through investtalk.com.
Hello, Justin and Luke. I hope you're both well. My question today is on General Mills. I believe the ticker symbol is GIS, George, Idaho, Sam. And I've been unhappy with the performance of this stock. I would like to sell all of it. Currently, it's about 3% of my portfolio. I'm thinking around September would be the time that I would sell and hopefully get a small gain. Thank you, and I hope you have a wonderful day.
I agree with you. General Mills, it broke down in the middle of last year from a high of around in the low 90s, and now we're down around $65, and it's really just been trading in this range since July of last year between, say, 65, hit a high of about 75. That was only briefly, but mainly the range between 60 and $70. Now we're at 65. So you're at the midpoint of that range. To me, this is just bearish consolidation, mainly because it just has a lot of debt to about $13 billion in debt on a $36 billion market cap. It's very low growth. Actually, earnings are supposed to be flat this year, down actually slightly from $4.52 to $4.50, and then rebound a little bit next year, but those estimates continue to come down as well. Revenues last quarter were down 6%, earnings down 10%. And in an inflationary environment, these type of consumer staple companies tend to struggle because they don't have enough pricing power to keep raising their prices, but they feel the brunt of labor costs for delivery and production and the input cost of production, et cetera. And so just the packaged food companies don't tend to do very well compared to other parts of the market. I don't see a reason to wait until September unless you're trying to get some long. You sound like you're at a loss. So I would just sell it and find a better use for this money, because I do think it is likely to head lower in time. Not tomorrow, not next week, but it's certainly a name that I think you should shed from your portfolio, because there are much better opportunities with that capital. So don't hesitate to get out sooner than September. Now let's play 2 questions in a row right now.
Hi, Justin and Luke. A couple weeks ago, you explained what a stop loss is. I was wondering if you could explain what a trailing stop loss is. Thank you.
So a trailing stop is just a little bit different. It's usually based on a percentage. So if you could say, okay, if this drops 10% from its high, I'm going to sell it. The trailing stop, meaning if it makes a new high, guess what? That's a new stop number. So that stop continues to march higher as the stock marches higher. And that can be a good way to do it, because but what you have to understand, though, is that every stock has a certain level of volatility. A 10% move in one name could be big versus another name, 10% could be minor. A big, volatile, mid-cap tech name, for example, high growth name with high multiples, it's going to move fast. It's going to move 10, 20% in short periods of time. Whereas, going back to the last caller, General Mills, 10% move in General Mills is pretty big because historically it just has really low profitability. So make sure you adjust that trailing stop for what position you are in, or the volatility of the position that you are in. But that's probably a better way in general, and it just kind of keeps moving that stop loss up as the stock rallies. So that's the difference between the stop limit and just a a trailing stop and a stop limit order. Thanks for the call. This is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART. The stock market is constantly changing, and serious investors want a way to get the latest news and unbiased investment insights. Welcome to the InvestTalk podcast.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Let's go talk to Rutosh in San Jose, looking at Occidental Petroleum. Do you own it or looking to buy it?
Hey, Justin. Yes, I have it. It's about like 3% of my portfolio. I'm looking to see if should I buy more or should I just hang on to it. Like Buffett has been adding it heavily, but the price hasn't gone really anywhere. And I was just looking to see if what should I do with my investment. Believe it or not, I'm actually under my investment in it, so I'm just curious, what should I do there?
Well, the oil market or the energy space in general has been underperforming over the past couple of months, mainly because oil pulled back. But oil held support and starting to look more bullish, I think, in the medium term. And especially if the Fed goes into an easing cycle, you'll get a couple of nice tailwinds to energy use. One is a weaker dollar. So it'll make those prices go higher. But also the foreign markets, emerging markets, their economies are likely to become a little stronger because a strong dollar tends to weigh on the growth in emerging markets. And so their currencies will go farther in dollars, and therefore the demand for energy will likely go up. So I think Occidental is a good name, is the best in the industry. You know, it isn't at the top of the food chain for us, but it's a good name. Like you said, Warren's buying it, so it can't be that bad. I'd be buying it if you have confidence in this name on this dip.
Okay, thank you.
Thanks for the call. Now, lastly, let's touch on a remodeling forecast. This is coming from the Harvard University Leading Indicator of Remodeling Activity for 2025, and this year, in 2024, the spending on remodeling is expected to fall for the first time since 2008 from $481 billion last year to $450 billion this year. Now, it's not supposed to bounce back above last year, but still back up to $461 billion by next spring. And there's a lot of factors that likely says that this year's dip is just a hiccup. Why is that? Well, a typical American home is entering middle age, meaning think of, we talked about the underbuilding of new homes in the past, really since the financial crisis, call it 15 years. And that means that there's a lot of existing homes that are 20 plus years old. And so a lot of them are going to need major updates. You know, I just see it, friends and family, they have those old kitchen counters with kind of the darker marble, and it's just kind of out of date. It needs to be updated and brightened up. And so there's a lot of people like that who have these homes that just need a update to the kitchen and the bathrooms mainly, right? Maybe new flooring. And they're locked into rock bottom mortgages. So they're unlikely to give up that mortgage, but instead they're likely to improve their home and rather than move and give up that mortgage. Okay. And then you have rising property values. It means there's a lot of home equity there for that to be tapped in say a HELOC, for example, or just a refinancing if they're okay with that. And so lower interest rates will unlock a lot of that. They'll feel more comfortable with a HELOC. They'll maybe feel more comfortable with a refinancing, et cetera. So there's a lot of things lining up to say homeowners are going to continue to spend on remodeling. And on top of that, work from home. I think there's still going to be a longer term trend. There was that big rush in COVID to build a home office, kind of expand their home a little bit more because they're spending more time in it. And I think that's still going to continue secularly, right? Maybe not that big rush like we saw in 2020 and 2021, but still that trend will likely continue. So this will feed into a lot of the, and we actually own these for clients, a couple of names that, they make kitchen cabinets and paint and new faucets and just all the things that go into remodeling a home, both in just a minor refresh, like a lot of people do, and as well as major refreshes. Okay, so understand that this is a trend that I think is durable and will likely be the case for a long period of time because of the really housing shortage in the country and so many people ready to get up to date with the latest styles with homes that really need it. So pretty interesting prognostication over from Harvard. Now I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.